Hi everyone, James here. When it comes to investing in local bank stocks, there are several factors to consider for investors. In this video, we will compare the different financial ratios of our three big local banks, DBS Group, UOB, and OCBC. We'll examine and compare their net interest margin, return on equity, cost to income ratio, their price to book ratio, and dividend yield. I will also add in the analyst target price. So before we get started, right, do help us to like, subscribe, and ring the bell notification for more interesting stock ideas and how to invest for the better. In return, I will show you a financial meme. Okay, with that, let's dive in. First metric, the net interest margin. Net interest margin is a measure of the bank's profitability and reflects the difference between what you earn from depositing money with them versus the interest income generated by the bank when they lend out money. So that's why, recently everyone is trying to go deposit because there's a lot of promo, right? They get your money and then they lend out at a higher interest rates to those like maybe going for condo installments and all that. Okay, and among the three of them, based on this table over here, DBS Group has the highest net interest margin at 2.11%. This is followed by OCBC at 1.91% and UOB 1.86%. On a side note, the recent increase in net interest margin is the reason why the three banks were able to deliver such good performance for FY 2022. However, all of them warned that global interest rates are likely to peak in the second half of this year, as some of them are already predicting that the Fed may cut rates in this year itself. Okay, so now let's jump over to the second ratio, the cost to income ratio. So this is also another important ratio that most people don't observe. Alright, and this ratio itself measures the operating expenses incurred by the bank as a percentage of the operating income that the bank earn. Okay, and this is used to gauge efficiency and productivity for the banks. Based on this table again, you can see that the three banks are so nicely in sync with each other at around 43% in terms of the cost to income ratio. And if you were to ask me, right, this is really a pretty good ratio, especially when you compare to the Europe. Their ratio is averaging around 60%. And based on this picture here, you can see several renowned banks and their respective cost to income ratios. Credit Suisse, you have 103%, UBS, you have 70%, Barclays 64%, HSBC 59%. All of them are higher than the 43% of our big three local banks. Alright, in fact, I feel that this ratio can be a really good telltale sign given that Credit Suisse ran into some default risk issue in the past year. 103%. How can you pay $1.03 when you are earning $1 income? That means you are losing 3% for every dollar you earn. Doesn't make sense. But anyway, on to our next common ratio, the return on equity. So ROE, in short, is a measure of how efficiently shareholder capital is being used to generate profit. And it is a very widely used metric to assess the bank's profitability. Here, we see that DBS Group still has the highest ROE at 15%. Okay, way higher than UOB 11.9% and OCBC 11.1%. If you ask me why DBS can get a higher ROE, it is probably because DBS has benefited from higher interest rates, 2.11% versus the other two banks, and also gain significant cost savings or structural savings, right, from their early transition to becoming a digital bank. Next, let's talk about the price to book ratio and dividend yield. Quick pause. WeBull just launched a great offer where new users just need to fund any amount and you can get 3 free fractional shares. And by any amount, I mean even a minimum of just $1. If you maintain your funds for 30 days, alright, you will get another 2 free fractional shares. So for those who have not heard of WeBull, they are regulated by MAS and it is also a very popular trading brokerage app based in the US. If you are interested to sign up, I have placed the link down below in the description. Do remember to do it quickly because this limited time offer will end on 1st of March. With that, let's jump back into our video. Okay, we always use price to book ratios to measure the bank's valuation ratio. Okay, because this ratio essentially compares their market value, that means the current share price times their number of shares, versus their book value. So what is inside the bank itself, all the deposits minus the the liabilities. For most banks, the yield and cost of funds are rather similar. Thus, when you compare the financial performance of the banks, assessing their bank spread, the lending rate minus the deposit rate is crucial. So hence, when a PB ratio is calculated, it depends upon the bank spread and the ability to keep the non-performing assets under control. So we will look at NPL in this case. And from the table, we can see that OCBC has the lowest price to book ratio among the 3 banks at 1.1 times, while DBS has a PB of 1.6 times. Alright, so dividend yield wise, UOB is actually offering the best yield at 5.0% if you don't take into account the special 50 cents dividend that DBS will be giving. And on that note, right, it means that DBS will give a total of $2 dividends for FY 2022, okay, translating into a 5.8% yield. You can also check out the peer comparison feature in Simply Wall Street if you're interested to grab all this data, right, to analyze your own stocks, not just bank stocks. You can join Simply Wall Street's Forever Free plan. You can get access to the premium plan with a 14-day free trial, and the first 100 to sign up using my link below will receive 40% off the annual plan. Okay, coming back to the last ratio, the Analyst 1-year target price. So investors can also consider this target price given how widely these blue chip bank stocks are covered by so many analysts. And over here, we can see that the potential upside is quite similar across the 3 banks, 14% for UOB to 16.5% for DBS. And in summary, right, while DBS Group has the highest net interest margin and return on equity, that means they are quite well managed and all that. Maybe because of their big deposit pool from all the Singaporeans, right? It also has the highest price to book ratio among the 3 banks. Personally, I would think that the 3 banks are fairly valued at the moment because there's a cautious outlook for bank stocks and no one knows whether we will enter into a long recession and the Fed may suddenly cut interest rates because of trying to boost the economy again and things like that. But then again, if you are looking to buy and hold bank stocks for their attractive dividend yields, I think this can be a good time, or any time is a good time to own these banks, since they give they offer pretty decent dividend yields and their dividends tend to only go up in the long run, disregarding COVID lah, of course. Okay, and again, for more ideas on how to invest your money and discover stock ideas in the Singapore and US markets, make sure you subscribe to this channel and hit the bell notification. Next up, if you want to check out 5 defensive Singapore stocks with at least 4% dividend yields, do check out this video over here. I will see you next time. Thanks for watching and ciao.